Experts are sounding alarm bells about bubble in Canadian housing market where we see record high prices, mounting household debt compounded by increasing bank rates. Let's explore in this video problems in Canada's housing market. Are the prices on a decline? Signs of distressed sales piling up? Are we heading towards a Canadian housing crash in 2022? And at the end, my perspective about it. If you're new to this channel, please subscribe to it alongside smashing that like button, as that will help me with the YouTube algorithm, which of course will be highly appreciated. I saw an article online that after hockey, Canada's favorite national pastime must be making housing market predictions and, if possible, flipping them as a side hustle. I see three distinct challenges that we should be aware of in Canadian housing market, which are prices being in bubble territory, elevated levels of household debt post pandemic, and times when lending rates are going up. No doubt people have to qualify their mortgages based on a stress test, but twin issues of recent fall in house prices as well as increasing cost to service that debt might become too much for some over-leveraged households. The fact remains, when central bank increases its benchmark rate steeply in a very shorter period of time, historically recession follows which will eventually affect jobs. Therefore, people's ability to service debt becomes doubtful. Hope you get the idea. Finally, Canada's housing market, which was red hot during pandemic, has shown first sign of weakness. According to Canadian Real Estate Association, volume of houses sold is down by 20%, whereas average price of house sold nationally is down by about 12%. Sales and prices are down disproportionately in Ontario and BC, which saw a biggest run up in prices as investors were piling money into real estate during pandemic when the rates were ultra low. All these are lagging indicators, hence effect of recent hike in interest rates are yet to be seen on the ground, which I believe is going to further put negative pressure both on sales as well as house prices. In order to cool down inflation, Bank of Canada is forced to increase its benchmark rate, but there are no indications inflation rate is slowing down. That gives a clear indication that more rate hikes will be done in the future, which may not be good news for investors. If your real estate cash flow was based on ultra low bank rates, which is long gone, now you might have to put in more money every month out of pocket to retain ownership of your investment. That is why a lot of house sales in today's markets are effectively from distressed sellers who might have borrowed money against their house to buy second or, in extreme cases, third rental properties. They cannot refinance it further because now their property appraisals are coming even lower. Therefore, in some extreme cases, when they run out of options as benchmark rates are on the rise, they have to sell, which increases volume of real estate listings. As a result, increases downward pressure on the prices. Nobody has a crystal ball that can predict whether we will see a housing crash this year or any time in the future. In spite of lofty Canadian real estate valuations where demand is record high, new listings shows no signs of increasing. Experts predict demand for housing will not taper, especially with immigration growth that we are seeing, where the fact remains that an average house price nationally has doubled as compared to January 2015. Now ask yourself, has your income doubled in the same period of time? Maybe not. That is exactly the reason why banks have been told by the regulator to start using stress tests some time back just to ensure borrowers can meet their mortgage obligations. Conventionally, housing has stayed as a long term investment in a portfolio where you enjoy home ownership and asset appreciation that comes with it. But with ultra low bank rates, people have started flipping houses for short term profits, which took its valuations to an unsustainable level. As a result, we are forced to shell out even increasing share of our monthly income towards housing cost, which in my view has to come down. But that is me, I might be wrong. Do your own due diligence before investing based on your risk tolerance. As a disclaimer, I'm not a financial advisor. Please consult one before investing based on your personal financial situation. If you like the content that I make, please help me and my channel by liking, sharing, and subscribing to it. Thanks for watching and see you in the next one.